Before the accountants come in and ruin the whole vibe, I want to throw a shout out to the Spark team for putting this together. This is an incredible event. Thank you guys so much for having us. It's really impressive, and for them to be covering it the way they are, that's incredible. So thank you guys very much. Hope you're all having a good time. No one's paying attention to the Leaf game right now. It's all eyes on us. So as we were introduced, my name is Claudio Martellacci, and this is my tax partner, Mandeep Khosa. We represent a firm called Grewal LLP, and we're a full-service accounting firm. And what that means is that we perform the typical slate of services: financial statements, personal income tax preparation, corporate tax preparation, HST, the typical stuff. But where we differ from a lot of firms our size, and we're about 60 people right now, is that we offer consulting services in valuations, litigation support, and tax. And when I say tax, I mean tax planning, tax consulting, estate planning, succession planning, the really nitty-gritty stuff that can go over a lot of practitioners' heads. We get called when that happens. And given that the event is called Investing in Florida, we want to help you do that. And how we'll start is, Mandeep, if you can tell us, how should we invest in a business in Florida as a Canadian?
Thanks, Claudio. Before I answer your question, I just want to start off by saying that this is a very rare sighting. It's April 27th, and you got a couple of accountants out here in front of you. I want you guys to call your accountant and see if they pick up the phone.
No kidding.
This is how we're different. So investing in this day and age is very easy. You can make an investment in the U.S. without having to step a foot down there. In the U.S., you can invest through a company by either having a C corporation, an S corporation, or as a LLC. An LLC is something that any investor in the U.S. would recommend blindly that you should be investing through. However, for a Canadian individual, that may not be the case, right? The reason an LLC is very important is because it's a flow-through entity. What does that mean? When you invest, there's typically losses in the beginning, right? Those losses, they get flown out to the individual investors. This is very important because those losses now can be used against any other income that you have. This is why an LLC in the US is one of the most common vehicles. However, from a Canadian standpoint, the CRA, and I know that's the forbidden word, starting with the letter C, right? The CRA, they don't recognize as an LLC as an entity here. And what that creates is a mismatch, right? So you get taxed in the US and then you have tax on the Canadian side. And that leads to something we call double tax. I know you guys don't want to talk about tax, but this is double tax, so it's twice as worse, right? This could result in tax that's close to 60 to 70% if you don't have a proper structure in place. So that's why it's very important that you have someone like myself and Claudio to get involved and make sure that you guys have the right structure. What we would recommend is having something like an LLC, but then also having what we call a blocker corporation between the LLC and the Canadian individual. That blocker corporation would be something like a C corporation, right? So again, we're not trying to get into the details, but this is where you bring us in and we make sure we avoid that double tax that could result in that situation.
Yeah, I don't think there's a worse set of words you could put together tonight than double tax, and I don't think anybody wants that. So very important to heed that advice. Really, when you're considering investing anywhere, really in anything, but certainly if you're doing cross-border, you want to involve your accountant ahead of time. Let them know what's up, let them know what's happening, and if you're worried that your accountant might not be the right person to go to, call us. That's what we do. So on that, let's get to the next stage, which is investing in real estate property in Florida in particular.
As you guys heard, investing in Florida in particular is a very lucrative market. It's a market that's on steroids, right? So one thing to keep in mind is how do you want to make that investment? Do you want to make it as an individual? You can do that, but as an individual, if something happens to you, you get hit by that forbidden bus that's coming for all of us, right? What happens? There's something called estate taxes. These estate taxes could be as high as 40% on the market value of your property or any assets that you own. Right? So again, we recommend going through either a trust or a corporation. And as I mentioned before, you can have an LLC with a C corporation, but there's different ways to make that investment to make sure that you're protected. When you have estate taxes, you have to find the liquidity event, right? You have to pay taxes in the hundreds of thousands of dollars, but you have the property. So either you have to sell your investments to get that cash to pay that tax, or you're better off planning ahead and making that investment that you can defer that tax to a later point in time.
Yeah, so I know being in Canada, like we know who the CRA is, and they obviously get a pretty bad rap overall. And you know, maybe that's warranted, maybe it's not, but I can tell you who you don't want to deal with is the IRS. And so we specialize in setting up plans so that you can minimize that potential burden and exposure in the IRS and the CRA at the same time, because you can have that when you're a Canadian investing, you know, overseas and in particular in the US. So what about a situation where you're not really investing in the US? Maybe you want to leave Canada altogether and move to the US and become a resident there and maybe a citizen. How do we tackle that, Mandeep?
Yeah, so we heard that right now it's 78 degrees in Miami, I believe it was, right? I would love to be in Miami right now than over here. So we all want to move down there. It's beautiful, amazing opportunities, amazing market. But before you decide to relocate permanently, again, speak to your accountant, because there's something called departure tax. What's departure tax? Is as the name applies. When you decide to depart Canada, there's a tax that you have to worry about, right? So basically what the CRA wants to do is whatever gain in your investments, whatever increase in value that you've had in your investments, in your properties, in your business that you've started up, they want to tax you on that before you leave. Because once you leave, they don't have any jurisdiction to tax you at a later point, depending on the type of assets that you own. So again, this could be something that's very costly to an individual, and it's a payment that you have to make when you intend to hold your Canadian assets. Right? So what we do is we try to plan around that. You have to be proactive. You want to get us involved prior to making that move. And there's opportunities to minimize that tax on your departure.
Yeah, and just to talk a little bit more about that. So the CRA will want to tax you on the difference between the cost base that you had and the fair market value of those assets as if you've sold them when you leave. But in a lot of cases, you haven't sold them. So you don't get the income or the cash from selling them, but you still got to pay the tax like you did. That can be a pretty big burden for people when that comes about. So what we try to specialize in is minimizing that tax burden and planning around it. For example, you might have a client who has an operating company and they want to leave, and we just had one that actually moved to Nashville, and he wanted to become a country music star. And so we valued his business and were able to shelter the tax through the lifetime capital gains exemption. So Mandeep, can you talk about what that is?
Yeah. So this individual had a business that was worth about $1 million. That, without any planning, that tax would be around $250,000, $260,000, right? So with the help of Claudio, we were able to do some work, some planning around it to make sure that he was eligible for the lifetime capital gains exemption. That's something that you guys probably heard of. It's $1 million that you can shelter without paying any tax on. So when the individual left, that $1 million in the increase of his business, there was no tax that he had to pay, right? So these are some of the strategies that are in place to minimize that tax on that eventual departure once you decide to leave.
Yeah, and these are the type of services that our firm offers. So, you know, I valued the business. Mandeep put together the tax structure and the tax plan, and that client was able to save at least $250,000 on that move when they really would have been in a bit of hot water if we didn't do that, right? So overall, like that pretty much wraps up what we wanted to talk about tonight. You know, we're trying to condense some very, very intricate pieces of the Tax Act into a very small allotment of time. So we can appreciate that we kept it at a high level. If you ever have any specific questions, I'm sure our contact information will be provided so you can reach out and learn more. But more than anything else, involve your accountant in the early going. That's super, super important. Don't tell them 3 months after you move, hey, I moved to Florida and I have a place in Naples right now. If that's a little bit too late. You want to tell them in advance so they can plan around it. And that's it, guys. Thank you very much for having us.